Tuesday, January 25th, 2022, Monaco 64, home of alternative economics and contrarian views. So it looks like the stock market and investors are clamoring for more accommodation from the Federal Reserve. The Federal Reserve, of course, meets today and tomorrow. I think yesterday I said they were meeting yesterday and today. That was a mistake. The FOMC meeting starts today and ends tomorrow. And of course, Jay Powell will conduct a press conference. There won't be the forecasts for the economic forecast. They make those every other meeting. Of course, the markets are very volatile. The last time the markets were this volatile was in the run-up to the FOMC meeting in December, which happened around the middle of December. And if you look here at the volatility index or the VIX index, whenever this index goes up, it means there's a lot of fear in the markets and people are buying protection like puts. And as you can see, yesterday we went above the level from the beginning of December. The Dow was down over 1,000 points. I think the NASDAQ was down almost 600 and the S&P was down about 160. And all of a sudden things turned around. A lot of speculation as to who triggered that turnaround. Zero Hedge thinks it could have been the Plunge protection team. And we'll never know probably, but they found out that there was a big seller of puts. So what does that mean? Well, when you sell puts, it means that you think the market is going higher. So right in the depth of the sell-off yesterday, some big market participant, be it the PPT or a hedge fund, sold a whole lot of puts. And when you do that, the people who buy the puts, they will hedge because they're market makers. So they will buy the futures in order to hedge their long put positions. Because by holding a put, it means you're bearish. So that turned it around, and we finished up on the day on the major three major indices. And the Plunge protection team, of course, was a group formed after the 87 crash by the White House, by the Reagan White House, by the Treasury, by the Federal Reserve, by the Exchange Stabilization Fund. All those four groups worked together to monitor the market, and I'm sure they were doing that yesterday. But I said earlier that the markets are clamoring for more liquidity. Yes, I think so. The Federal Reserve hasn't even started tapering, as we've seen from some charts that I've shown you. They're still tapering at the same pace. They haven't even started raising rates. Supposedly they're going to do that in March. Some investment banks like Goldman Sachs and JP Morgan think they're going to do it even like 4 times. But yesterday, according to Zero Hedge as well, the expectation for rate hikes decreased quite a bit on the back of the sell-off. And I was reading the Endgame Investor today, Rafi Faber, and I agree with him. He says here that post FOMC tomorrow, because FOMC is tomorrow, he's saying Thursday, but the markets can still react on Wednesday. I think if the Fed shows a hint of turning a little bit dovish from the other meetings, we could see gold and silver really explode higher. Yesterday, gold did very well, I would say. It was mostly unchanged to slightly lower or slightly higher throughout the day, even when the Dow was down about 1,000. We did test the 1830 level, but it held that really well. And so, yes, gold held very well. Silver actually has corrected from the big move it made last week. But all in all, it's still up on the year, which is quite interesting. Gold is just up slightly on the year. Of course, all the major stock market indices are down. The bond market is down on the year, even though yesterday I noticed that the Treasury market didn't do much. Yields were down only about 1 or 2 basis points on the 10-year when the market was down 1,000 points. So that wasn't very good in terms of financial conditions. So, yes, I think we could see a turnaround in the stock market as well, especially if the Fed hints at any kind sign of dovishness in their meeting tomorrow, in the press conference. So, yeah, Rafi thinks that's going to happen as well. That could happen. We're also seeing a lot of negative data for the economy. And even though CPI or inflation is still elevated, I think the markets will ignore that. And maybe even the bond market will ignore that, because they're still in this mindset that if the economy slows down, then inflation is going to come down. And that might help the Fed drag its feet even more. So I think we're in really interesting times here. So yesterday, in terms of data, we had some PMI data from the US. Manufacturing PMI came out at 55. It's expected 56.7. So that's still okay. A number at 50 means that the sector is not moving up or down. It's stagnating. Above 50, it's growing, and below 50, it's shrinking. But the interesting one was the market composite PMI. That the previous number for that was 57, and it came out yesterday at 50.8, so just above 50. And also the service PMI. Services are a big part of the US economy. It's a service economy rather than a manufacturing economy. And that number was expected at 55. It came out at 50.9. So I think the Federal Reserve is getting more and more excuses to hold off reining in the accommodation. And I think the markets are telling the Fed that you raise rates too much, or you run off the balance sheet too much, and there's going to be a crash. If that's what you want, that's fine. But I'm not too sure. I don't think the Fed wants that, even though some people think they want to pull the plug. But either way, I think having physical gold and silver is still the way forward, because the best environment for precious metals is when you don't have stability in the monetary system, be it on the upside in terms of inflation, or on the downside in terms of a total crash and bankruptcies. You don't want counterparty risk. I noticed yesterday as well, the miners didn't do very well. The gold and silver miners have given back a lot of their gains they had last week, but they also rebounded at the end of the day. And before I look at where the markets are this morning, then, I just wanted to touch upon what's happening here in the UK. We are also seeing that they want to backtrack on tax rises. Am I for tax rises? No. But we know that a lot of the inflation that we are having now, the rising prices, it's not come out of the blue. It's happened because they shut down economies all over the world for 2/3 of a year, especially here in the UK. And they pumped borrowed money financed by the central bank, which created that out of thin air. Borrowed by the government, and they gave it to people for not working. And is it any surprise now that the cost of living is going up. It's not. It's very simple. We're actually paying for all the furlough, all the schemes that they came up with to keep people from starving and keep people at home happy watching Netflix and chatting on Zoom. Of course, they didn't think it was that serious, the pandemic. We're now hearing that Boris Johnson had his own birthday party in June 2020 for 30 people, while we were at home, not being able to meet anyone except the people we live with, and we could only go out for food shopping. We couldn't go to play golf or anything. You could only exercise half an hour a day. So yeah, that's a different story. But the reason tax rises are important is because the markets and investors, especially in the bond market, they want to see the government rein in all the borrowing and deficit spending. And how do you do that? Well, by allowing the economy to grow, private sector, which they're not really doing, by unfortunately raising taxes to pay off the deficit. But now, as you can see here, Rishi Sunak, who's the Chancellor of the Exchequer, or the US Secretary of the Treasury equivalent in the UK, it says here, has room to delay national insurance rate, says IFS. Delaying the national insurance increase by a year would be fiscally fine, says the director of IFS. So they're just kicking the can down the road. They're saying, well, 1 year won't make a difference. It's going to be okay. The problem with that is, come next year and we're in the same sluggish economic position, and according to some, though, our economy is doing well, and we have to delay this. So this is very serious. It's just going to make it worse. You might say, oh, if they delay national insurance increase, people are going to have more money. Yes, they will. But it's only going to inflate things even more because the government is going to be running bigger and bigger deficits. Their excuse here is that the public finances are looking better. Well, we had some numbers this morning about the public finances, and the UK public sector net borrowing, or the budget deficit for December, was expected to come out at 15.2 billion pounds deficit, how much they needed to borrow, and it came out at 16.1, so that's worse. So yeah, I don't think, unfortunately, the cost of living crisis is going to improve. I think prices are going to keep rising. The pound's going to keep falling. And this is not just in the UK, it's all around the Western world. What's the solution? Well, there isn't a solution. This is payback time for not just financing a lockdown for 240 days, but also for financing mistakes of the bankers many years ago in 07, 08, 09, many other things. This is, this eventually the rubber meets the road, so to speak, and we have to pay for things. And why am I talking about this? Just to make people aware that things aren't as great as government will make it seem. Anyway, with that, let's look at where the markets are this morning. It's just past 9 a.m. London time. So yesterday the stock market was actually up when I spoke, the futures. And then, of course, they turned around. This morning, they're down. So I'll start with the Dow future. It's down 300, or just under 1%. The NASDAQ is down 300, or just over 2%. And the S&P 500 future is down 1.5%, or 68 points. So still a lot of volatility. Gold is down just under $5 at 1838.40. High has been 1844, and we're right near the lows here. Silver, silver having a tough time. It's getting bunched in with riskier assets and commodities. Right now we're down 29 cents at 23.70. Low has been 23.67, the high 24.02. I think yesterday the low was 23.55. The FTSE index is up 11 points. To the currencies, sterling is unchanged, 134.85. The euro is down 0.25%, 112.95. The dollar is unchanged versus the yen, 113.93. And the dollar is slightly higher versus the yuan at 633.43. Aussie dollar is unchanged, 71.38. The dollar is up 0.1% versus the Canadian dollar, 126.49. And the Kiwi dollar is down 0.4% at 66.72. To the commodities, WTI crude is up 0.33% at 83.40, and high-grade copper is down 0.5% at 439.73. And to finish off, just a quick look at the 10-year yield. We are at 177, so up 3 basis points. So the 10-year yield is actually up. And if you look at what happened yesterday, when the Dow was down 1,000 points, the 10-year yield was only down 2. And now with the Dow down about 300, it's up 3. So I think there's something wrong in the financial system. It's not good. And I expect to see continued volatility. And of course, the FOMC is going to be what people are going to be waiting for. And we could see some big moves tomorrow after, well, it's after 2 p.m. New York or 7 p.m. London, after the FOMC announcements. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to this channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.